You're entering the future-ready CNBC-TV18 EBIX Cash Studio.
Well, the Sensex is just inches away from 60,000 and the Nifty a few inches away from 18,000. What a great time to have an investor summit, and that's exactly what JPMorgan is having, their 6th India Investor Summit. And joining us ahead as a curtain raiser to that summit are Sanjay Mookim, India strategist and head of equity research, Sajjid Chinoy, the chief India economist at JPMorgan, and Madhav Kalyan, the SCO India and CEO JPMorgan Chase India. Gentlemen, thank you very much indeed for joining us. Well, I mean, there is so much to ask you. Let me start with you, Sanjay. You couldn't have picked a better time, but can you start by telling us what your investors are telling you? We will just run the FII numbers for September and, of course, for the remaining months. There has been just a burst of FII flows in this month. What are they smelling so good in India?
Good morning, Lata. Great to be on. To answer your question, there are two kinds of feedback we're getting. One, of course, people are happy, the markets are buoyant, but this is also becoming a particularly difficult time to invest because stocks are moving far more than investors would expect. So finding correlations, finding drivers of stock price movements are becoming trickier. So it's making fund management and long short investing a little bit more difficult than you'd expect normally. But yes, the expectation is that, look, the global liquidity environment remains very supportive. There is also issues in the rest of emerging markets, for example, and India seems to be the one shining star in EM for now and seems to be benefiting at the moment.
Okay. Yeah, Sanjay, I'm going to come back to you to check out how you are helping your investors sift the wheat from the chaff, because as you say, valuations are skyrocketing for everyone. But first, to use Sajjid, do you think there is a case for upping growth numbers? I think all of you are standing at 9.5, like the RBI is, give or take a few basis points. But, you know, exports have been firing very well, and the government is making much more money than it was. Who estimated that the April-July numbers that we have would be, you know, 75% over 2019 numbers? The CAGR of, you know, over 20-30% in terms of tax collections. So the ability to spend more. Short point, therefore, given exports and the government's ability to spend, are we looking at a better than expected GDP?
Hi, Lata. Good morning. Great to be here. I think, you know, one has to separate what's going to happen over the next 3 years with the next 3 quarters. Okay. I think for this particular year, we're probably comfortable with the GDP growth rate of, you know, close to 9%. The good news, of course, is the pace of vaccinations has gone up because that really sets the stage for, you know, what the economy will look like over the next 4 to 6 or 8 quarters, and without the constant fear of recurring waves. But as you pointed out, I think it's important to step back, and even as we've reached pre-pandemic levels, recognize that 18 months into the pandemic, I think going back to the pre-pandemic level is not a sufficient criteria. We now have to start measuring ourselves compared to where we are compared to a pre-crisis path. And even if India grows at 9%, like most other emerging markets, we're going to be below that pre-crisis path. So figuring out a growth strategy for the next 2 or 3 years is going to be crucial. And that's where your question is so important, because I think, you know, we have to accept the fact that both consumption and private investment will take some time to recover. Consumption was slowing before the pandemic. There's been some hit to labor markets and balance sheets. Private investment, the good news is there's been a lot of deleveraging. Balance sheets of the large corporates are in much better shape today than they were 5 years ago. Absolutely. The issue really is demand. It's utilization. If you look at the RBI's latest Orbicus survey, utilization of manufacturing is in the mid-60s. Where will that demand come from? As you said, it'll have to come from exports and government spending. Now, the export lift is cyclical. So what we have to do is lay the groundwork now so that even when the cyclical lift goes away, India can, you know, keep increasing its market share, particularly in manufacturing. It's happening in services. But this is where government spending becomes so important. And the silver lining, as you laid out, Lata, is that revenues are stronger. We've seen a formalization of the economy, and that's showing up in higher revenues. It's important that we don't over-tighten the fist. The glide path that's laid out is a very sensible one. So if we get higher revenues this year, it should be plowed into higher capital expenditure with its large multiplier effects.
Okay. Okay, I'll come back to squabble with you on the consumption and investment front. My sense is that at least consumption looks better than what the IIP numbers and the GDP numbers indicated. But that battle a little later. Let me get to Madhav. Madhav, what are first, good morning and welcome. I doubt we've spoken to you earlier on CNBC-TV18, so good to have you. How are investors, the foreigners whom you're inviting, looking at the non-GDP, non-corporate story in terms of what the government has done? And they've taken a series of, minor steps, small steps. I don't want to use the word reforms because, it's getting ugly and too much of a hold all. See, the Vodafone, the telecom steps, the asset monetization steps, the asset reconstruction steps. A lot of other things have happened. Is there good reception for that?
Thank you for having me, Lata. At the investor conference this time, we have 775 investors coming in to interact with about 75 companies. But the thing that they really look forward to when they come to the conference is the ability to engage with policymakers on precisely what you spoke about. The ability to be able to speak to and hear from policymakers each of those areas that you actually spoke about. So we do have cabinet ministers, we have policymakers who will be engaging with investors on the most recent set of reforms. We are hearing positive messages on each of these. Telecom, we are hearing about the NARC, the formation of the bad bank, just in terms of the efficiency that it brings in being able to consolidate the asset and having to deal with just one counterparty, as opposed to having to deal with many counterparties who have different motivations in the way they engage in dealing with a distressed asset. Here, just that move to be able to deal with one counterparty with commercial considerations, investors are telling us does make a lot of sense. Early days, but over the next few days, even as investors engage, these will be areas of deeper thought and deeper debate at the conference.
Okay. Well, I want to come back to you about the private equity capital that's coming in and whether, the stressed asset funds would be interested in this separately also in other private equity activity. But Sanjay, I think everybody wants to hear you because of the way the markets are. What is JPM selling to foreign investors? Will it be the consumption story? Will it be, despite your report on Zomato, which isn't positive, you're one of the few people who are looking at a lower price than what the current price is. Everyone has a buy in spite of the current price. But what in the consumption story are you selling, if at all?
Right. So we are very clear in our recommendations, Lata, because there are two aspects to, I think, what is happening in the market. We termed it the Icarus trade early in January, where we argued that liquidity will fill the wings of the market and raise multiples and valuations. It's frankly gone on for longer than I had expected, but that is the phenomena I would highlight is driving valuations and multiples higher. However, in terms of stock selection, our framework very clearly relies on earning surprises. And selecting stock A versus B depends upon the ability of the company to deliver earnings better than expectations. And if you believe that framework, and we do, that is something we really want to push, then we really like the rate-sensitive space in India. Because the one thing that is frankly happening in the near term from a policy perspective is the significant monetary stimulus in the economy, with liquidity being surplus, rates being at multi-decade lows really. And I don't think that India is in a situation where there's no demand for credit. So we believe, and we've done a lot of work in our research to highlight why, as the economy opens, we should see better credit flow in the system. Therefore, the rate-sensitive sectors such as banks, autos, and possibly real estate and associated sectors are the ones we want to focus as being candidates to potentially deliver surprises.
Okay. Oh, well, that's not in the fashion, right? Because Bank Nifty is a little behind the other indexes. So maybe you're also picking value at this point in time, maybe more headroom. Madhav, what is the private equity interest in this space? Whether it will be asset monetization or whether it will be this NARCL, stressed asset funds. Do you see them being interested? I mean, private equity is coming into India like never before, Will they come into finance sector?
So the private equity space, the private capital flows into the market have been strongest this year. Three trends have been driving it. Firstly, a lot of the private companies have become much larger in size than they used to be, which then brings meaningful tickets for private capital market investors to consider. Second, the set of investors looking at India has broadened significantly. And the third trend is, given that new age economy companies have a natural exit now into the equity markets, the private capital market space then ties in very well, not just looking towards M&A for exits, but also looking at public markets for exits. So these three trends are really feeding. This year already there's almost about $10 billion of funds that have come into the private capital market space. And the transaction sizes, Lata, have really increased. We led a transaction which was almost $3.7 billion into one of the new economy names. So the sizes have materially changed in the private capital market space. Distressed and infrastructure, those are areas that will be of interest. I think even as the ability to bring in debt into or debt-like structures into InvITs and REITs and policy guidelines on that actually play out, I think there will be interest in that area. Stressed assets, there is selective interest right now. I wouldn't say that there's a lot of money that's coming in there, but as the NARCL forms, as 90,000 crores of assets then get transferred there is clarity in the process that's getting set up. I think we will see interest.
Okay. Now, why am I asking you a sour lemon question when there is private equity coming, hand over fist in other areas? Why should I ask for finance? But tell us a little more about private capital. What you, like you said, that they're coming in one of the digital names which you all spearheaded. But what is their interest? Which are the nature of businesses?
So we are seeing interest across areas. New economy obviously has a disproportionate share of private capital coming in, but we are also seeing it in specialty chemicals. We are seeing it in old economy names as well, because lots of companies have actually scaled in terms of size and tickets, as I mentioned. So we are seeing money coming in a disproportionate manner into the new economy space, but the traditional economy is receiving its share as well.
Okay, well, that's a lot of money. And what does that mean to the economy? I want that answer from Sajjid, but we have to take a break. Coming back in a minute.